Okay, thank you. Um, so welcome to our lecture. This is our second lecture on financial reporting and analysis. So from your previous lecture, you had a rundown of the topic that you are going to be doing in this particular module. So you didn't touch anything in specific. You just had a rundown of all the topics. So today we are going to unpack the mysteries of Unit 1. From the previous lecture, the final aspect, I would like to talk about the final aspect you did about account balances. I'm not sure if everyone is comfortable in as far as account balances are concerned, but I'm just going to share this one with you. If anyone is having problems with memorizing account balances. So on your screen, you'll see we have a T account. The left side is the debit side. The right side is the credit side. On the middle of the T account, we see the word pairs, which is an abbreviation of those things that are highlighted. So the first P is for purchases, or in your case, cost of sales. So all the items that are on the debit side have got a debit balance. All the items that are on the credit side have got a credit balance. So you can just use that formula when you are not aware or when you are not sure what account balance the account you are having has. So the first P is for purchases or cost of sales. They have a debit balance. The E is for the expenses. All the expenses have got a debit balance. And then the A is for the assets. All the assets have got a debit balance. Then we go to the credit side. The R is for the returns. We'll talk more about this as time goes on, but all the returns have got a credit balance. The L is for the liabilities. We talk of loans and stuff, they've got a credit balance. We're going to talk more about this. And then the sales have got a credit balance. So I would like us to ascertain one thing first before we begin. The fact that the most important characteristic of a student is the ability to ask questions. So as we conduct these lectures, we expect questions to be coming from you guys so that we know what you know, what you do not know. However, if you do not have, if you by the end of the lecture you will not have any questions, it's not a problem. I do have some of my own for you. So at the end of the day, we must have questions, whether they are coming from me or they are coming from you. So in the course of our lecture, I'm going to ask a few questions because I want to ascertain what you guys know and what you do not know, so that I will know which assumptions I would make in future or which assumptions I should not make. And then today's lecture, without wasting much of your time, is focused on Unit 1 of your module, which is understanding the financial statements. So we want to do financial reporting and analysis, but we cannot be able to do so if we do not understand what are financial statements. Why do we have to have financial statements? So you find that today's lecture is largely made up of the theoretical aspect of accounting. So what we want to do is to build a house. But to build a house, we need a strong foundation. So this is the foundation to the accounting profession as a whole. So the whole of accounting profession is based on this lecture, on understanding the financial statements. So let's go right into it. So one would ask, what really is financial statements? What are we talking about when we talk of financial statements? They are simply a record of the financial activities of a business. What I'm saying is, as we conduct business operations, we enter into agreements with third parties, binding agreements with third parties, or even agreements with internal stakeholders. Those agreements are what we refer to as activities. But when those activities are of monetary value, they now become financial activities. So the accounting profession requires us to record each and every aspect of financial activities. Each and every aspect of financial activities must be recorded. And when we record those aspects, we are putting them in the financial statements. The financial statements are presented in structures. We do not approach the financial statements from a random perspective. So you will see in the course of your study that you have formulas that you are expected to know from the back of your hand that you must follow and that you must adhere to when you are performing your financial statements. It is very important that you familiarize yourselves with these formats of the specific financial statements that we will be dealing with. The failure to adhere will result in deduction in marks or even failure in your module. So it is very important that you know the format of financial statements. Okay, so at this level, we're expected to know 4 specific financial statements. So I'm going to tell you which financial statements, what to include in each and every statement, and what is the role of each and every statement. The first statement that you are expected to know is the statement of comprehensive income. So this is the statement which contains the details of the income and the expenses of the company. So when we go to the statement of comprehensive income, we must find 2 things, and 2 things in particular: the income of the company and the expenses of the company. Let's talk about the income. What income should we expect to find in the statement of comprehensive income? It's not just random income. We've got many sources of income when you talk of business. But in the statement of comprehensive income, we want to only see that income which arose due to the activities of the business. So from the normal operating procedures of the business, that's the income that we expect to see in the statement of comprehensive income. For example, we expect to see the sales. As we conduct business, we might be in the business of selling. So we want to see the sales of that item which we sell under the income section. Or for instance, we might have buildings that we are not using and we are renting them out. And as a result, that rental income is part of the income that we should see in the statement of comprehensive income. So as we proceed, you will see that we have many various forms of income that we are expected to know and that we are expected to include in the statement of comprehensive income. And if we go to the first page I showed you, that is the balances, you find that the income goes on the credit side, which means that the income has got a credit balance in the statement of comprehensive income. And then we also find the expenses of the company, or the expenses that you might think of. We are going to look at them in the following slides, but just to mention but a few, you might find the advertising expenses. You must find the depreciation expenses and any other forms of expenses that you might see. So you realize that we have income and the expenses. What we want at the end of the day is the net of the two. The reason why we are in business is to make profit. So this is the statement that enables us to see whether we are making a profit or we are making a loss. So the net of the income over the expenses gives us either a profit or a loss. So if the income is more than the expenses, we have a profit. But when the expenses are more than the income, we record a loss. So we use the statement of comprehensive income to determine whether the business is making a profit or a loss. So it is very important that we master the concept of the statement of comprehensive income, because it is the backbone of why we are in business. If we cannot tell whether we are making a profit or a loss, we might as well stop the operations of the business, because we are in the business to make a profit. That's the first financial statement we are going to be looking at, the statement of comprehensive income. And then the second financial statement we are going to be looking at is the statement of financial position. The statement of financial position. So we want to know from the name of the statement, it tells us where we stand in terms of the finances of the business. So what do we expect to find in the statement of the financial position? We expect to find three things in particular. We expect to find the assets of the company. We expect to find the liabilities of the company. We expect to find the equity of the company. All of these three we are going to explain in detail in the following slides. But just to explain a bit on what these are, from your previous lecture, you recall it was mentioned that the assets are the resources controlled by the company. What you have in the company, be it motor vehicles, be it land and buildings, and this can be categorized into two, current assets and non-current assets. Current assets from the notion that they can be converted into cash within a year, or they can be used within a year. And non-current assets from the sense that they cannot be used within a year. We buy them for the foreseeable future, maybe 5, 10, or even more years. And then the liabilities are the obligations of the business. As we operate the company, we will need capital, we will need money from other sources aside from the business. So we will need money from external sources. So these liabilities are found in the statement of financial position. And also, like the assets, they can be categorized into two, the current liabilities and the non-current liabilities. And then we've got the equity, which we also find in the statement of financial position. Here we include the capital of the owner, the drawings that they make. So capital increases the equity and drawings reduces the equity. We will explain this further in the following slide. So I have mentioned earlier that we use the statement of financial position to ascertain the financial position of the company on a certain date. And then the other statement, financial statement that we are expected to know is the statement of changes in equity. Statement of changes in equity. We've talked about equity here. Now we see that we have a statement of changes in equity. This is a statement from the name that presents the changes that happens in the equity. Equity is simply what the owner brought in and what the owner took and what the owner gained. Because when the owner bring in capital, when the owner brings in money, they expect to make profit out of it. So when they make profit, we see it in the statement of changes in equity. When they make a loss, we see it in this statement. So this is a very important statement that we will also look at in detail as the course goes on. Then we have, last but not least, the statement of cash flows. The statement of cash flows. So this statement summarizes the amount of cash entering and leaving a company. The amount of cash entering and leaving a company. This is a very, very important statement, because the lack of it may result in the company going into liquidation or going into closure, but it had profitable operations. So the failure to manage the cash of a company becomes a disaster for the business. So in order to tackle that, we need to have a statement which shows us how we are going to manage the cash, or how we manage the cash, and maybe improvements on how we can manage the cash in the following period. So these are the four types of financial statements that we are expected to know. And we should know these ones from the contents of the statement, the format of the statement, uh, pertaining what goes in the statement and what does not go into the statement. So that's about it about the financial statement. Then we move to the following slide. So why are we required to produce the financial statements? Who needs the financial statements? And for what do they need the financial statements? Otherwise, we might be wasting our time producing something that someone never uses. So there must be a reason why we have a fuss in producing the financial statements. So on this slide, we are going to talk about the users of the financial statements and what they use those statements for. So I've just took not many users and not many uses for the purposes of this lecture, but there are many users more than this, and there are many uses more than this, which you can look at. This is just to give you a brief on what we mean by the users and their uses of financial statements. So the users of the financial statements can be categorized into two. We can have internal users and external users. So the stakeholders of a company can be internal and external. When I say stakeholders, I mean those people who have interest in the business. So they can be internal or they can be external. External stakeholders are those that are not part of our business. Our profits, they do not benefit anything from our profits or from our losses, neither do they lose anything, but they need to know our financial statements for specific reasons. So this list is mixed both with internal and external users. So the first user are the owners of the company. Obviously, the owners of the company need to know the statement of financial position, the statement whether we are making a profit or a loss, how we are managing our cash flows. So they want to assess the safety of their investments, whether they are still making a profit or whether they are making losses. So they would need to know uh, the statement of the financial statements to ascertain their investments. They need to be sure that the company is generating enough revenue for them. They need to be sure about that. And then, so these are internal users. And then we've got banks and lenders of capital. This is an example of an external user of financial information. So as each business runs, it will need capital from external parties because most of the times business owners do not have enough to run their businesses. So they will need a helping hand to help them with the what? With the capital. So those who offers us capital, they need to be to be made to be sure that they will receive their repayments. If they lend us money, they need to know that they will get it back. So they can only know so when they look at our financial statements. We've got the employees. This is a type of an internal user. Employees need to know the financial statements of a company for job security, because you need to know if a company is making profits, that next year you will be at a job. But if it is making a loss, you will need to know whether you will be at a job or you will be out of one. So employees need to know the financial statements of the company for job security. And then we have potential investors. We have potential investors, those people who wants to invest in the company. So you notice that we have got lenders of capital and potential investors. Both are bringing money to the company, but both are different. These ones do not take interest in the company. They just lend us the money. We use it, we pay them back their money. But with the investors, they lend us their money, we use it, we pay them back. But if we made a loss, they will have to have their share of the losses. So with banks and lenders, they do not accept any losses, but with investors, they accept losses. So they will need to know the statement, the financial statements, again, to ascertain whether the company can be able to pay back their investment. And then last but not least, we've got the management, which is an internal user. So the management will need to know the financial statements of the company for future planning. If we know that last year we made a loss, we'll know what we can do next year. Should we cut back on our expenses? How can we increase our revenue? So the management will need to know about the financial statements. So these are the users and their uses of the financial statements. You guys can look for more. There are more users and there are more uses. So you can look for more when you find the time. So accounting is a process. Accounting is a process. We do not tackle a process from a random perspective. We must have certain rules, certain procedures to follow. These rules and procedures are what we as accountants call the GAP. You talked of it in brief the last time. So GAP stands for the Generally Accepted Accounting Principles. Generally Accepted Accounting Principles. So if you look at the definition I gave here, I say these are the common set of accounting principles, standards, and procedures that company use to compile their financial statements. So to compile the financial statements of a company, you need to follow these principles, standards, and procedures. Let's talk about principles from a human point of view. When you say you have got principles, we just mean things that you live by. I don't do this, I don't do that. This I do, this I do. So as accountants, we have those too, but they are standardized across the whole profession. What we are expected to do, what we are not expected to do. As I said, accounting is a process. So as we conduct that process, it runs from the first day to the last day, which we'll talk about that. It's a period from the beginning of the year to the end of the year. So throughout that period, you have to be guided by the principles, certain things that you must know that you are allowed to do, and certain things that you are not allowed to do. So you see that at this level, we are going to be more focused at these principles. The standards now refers to the rules, or the exact framework of what we are expected to follow. You are not required to know about this, but just to highlight, you will be using them in your statements of financial positions, but without knowing what standard did you actually apply. Every item of financial statements or every transaction, they've got a standard that is applied to it. So you will be applying standards without actually knowing which standard you are applying, because you are not required to know about standards at this level. And then we have procedures. Procedures are the day-to-day processes, the invoicing processes, the cash management, the petty cash management processes, etc., etc. So these processes allows us to have a financial statement at the end of the year, because we have to combine all those individual transactions into a single financial statement. So these procedures are very much important. Again, we will not be looking at these in details. So what we will be looking at is the principles. The principles is what we'll be looking at. So why should we follow the GAP in preparing financial statements? Why should we follow the generally accepted accounting principles? Because we want to encourage the standardization of financial statements. When one looks at the financial statements of a South African company from America, they should be able to understand where they are coming from and where they are going. So the GAP helps us to maintain uniformity. Huh? So you find that everything will be uniform, because the format that they use at one place is also the format that we use here. So one can be able to read and understand what you are trying to communicate. And then also, the gap contributes to the quality of the financial information that we are providing, because the principles are not biased in any way to favor a certain individual. They are there to protect the business from individuals, and they are there to improve on the quality of the financial statements. So that is why we stress on the use of the GAAP, or the GAP, the generally accepted accounting principles. So we want to look at the principles in particular. We want to look at the principles in particular. Again, I did take some of the principles that you look at, or the principles that you face on a day-to-day basis. I have left a few for you to look at. The first principle that we are going to be looking at is the consistency concept. So the purpose of the consistency concept is to ensure that transactions or events are recorded in the same way from one accounting year to the next one. So we want to adopt the same procedures that we apply this year. We want to adopt them next year. We want to adopt them the year after that. There's a certain company that I know. In their payroll procedures, depending on the time of the year, they pay using hourly. When they pay on hourly basis, when business is low, and then when activities are high, they pay using a fixed figure. So it is a problem to the business, because you cannot be able to tell, or you cannot be able to plan what costs are you going to reserve for human resources in the following, say, 3 to 4 months. You cannot be able to tell, because at one point you are using the hourly basis, at another point you are using the fixed salary. So it is important that you are consistent in terms of how you apply the principles. The other concept, the other principle that we apply when preparing the financial statements is the double entry system. This is very, 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 very important in as far as the accounting profession is concerned. So the double entry system simply entails that for every debit entry, there must be a credit entry for the same amount. We will look at it later when we do the accounting equation. This is what allows the accounting equation to balance at all times, because for every debit entry, there is an equal and corresponding credit entry. So when you make an entry, a debit entry, you must always make a credit entry. We'll look at it at this one in detail. And then we've got the going concern concept. So it is presumed that the entity will continue to operate in the future. So as we perform our business operations, we do so with anticipation that the business will continue in existence for the foreseeable future. We cannot continue to prepare financial statements if we assume, or if we have got reason to believe that in the following, say, 3 months, we are going to have to close the business. We must properly disclose that in our financial statements, because remember, there are people who need to use our financial statements. So if we do not tell them that we are going to be closing in the next 3 or 4 months, or in the next year, they might make a decision to invest in us while we are on the verge of closing down. So the going concern concept specifically tells us that if we, for any reason, think that we are going to close the business, we must mention that in the statements of financial position. So if we do not think that we are going to close, we make a presumption, or if we do not have any reason to believe that we are going to close, we make a presumption as we prepare our financial statements, that we are going to close. We do not have any reason to believe that we are going to close, we make a presumption, or if we do not have any reason to believe that we are going to close, we make a presumption as we prepare our financial statements, that we are going to close. We make a presumption as we prepare that will continue in operation for the foreseeable future. Then in accounting, we've got an accounting period. An accounting period is usually a 1-year period. It can start whenever we want it to start. It can start on 1 January to 31 December. It can start on 1 March say 2021 to 28 February 2022. So you might find a question that has got 2 years, 2021 and 2022. The accounting period can run from this year and end the following year. It does not necessarily mean to say that we have got 2 years. It's still the same period, so long as the 12 months are not reached. So we only have a period when we have 12 months. So what it therefore means is we can start an accounting period this year and end next year. It's very normal. You are going to find such scenarios when we tackle questions. And then the next concept is the matching concept. The matching concept. So this says that all income earned and expenses incurred to earn the income are matched with each other to calculate the profit for the period which they relate. So let's say we have got an accounting period from 1 January to 31 December. The income that we should include in the financial statements is that we found from 1 January to 31 December. The expenses that we are going to include in the financial statements are only those that we find in that very same period. So we want to match the income of that period to the expenses of that period so that we can ascertain whether we made a profit or a loss. We cannot take expenses from the previous period and put them in the current period, or neither can we take income that is meant for the next period and put it in the current period. We are not allowed to do so by the principle. So only the income that relates to this year must be included. The expenses that relates to this year are the ones also that must be included when we are preparing the financial statements. So you'll find that we are going to, as we will be doing questions, we are going to be faced with challenges whereby we have the income, let's say a certain expense we've paid for it for the next 3 months, and yet we want to know about only the expenses up to the month that we are in. So we have to make necessary adjustments to exclude the additional 2 months that we must not include in the financial statements. We'll see that when we attempt questions. And then we have the accrual principle. Accrual accounting is an accounting method where revenue or expenses are recorded when a transaction occurs rather than when payment is received or made. So this is similar to what I've just explained, that you see that we might incur the rental expense in this month, but we might pay it in the following month. That does not mean we record it in the following month. No, it means we have to record it in this month, and then the actual payment can be made in the following month, but the recording of the transaction should have happened when the expense was incurred. The same applies with the income. If we receive income for the following periods, we have to make necessary adjustments to account only for the income that we should account for in the current period. So that's the accrual principle. Again, we'll see it in practice when you attempt questions. And then there's the conservatism concept. So the conservatism concept simply states that we realize losses or we realize expenses as soon as we think or we have a general hint that we are going to have a loss. In the previous lecture, you talked about provision for bad debts, whereby the management would just look at the debts and then they would think that of this amount, so and so would not be able to pay, and therefore we must record it. So when we do that, we are applying this principle we are applying this concept. So it states that if we think that we are going to make a loss, we must show it in the statements of financial position. But if we think that we are going to make a profit, we mustn't show that in the statement of financial position. So a loss, yes, we can show, but a profit we cannot show. So it's like we are operating from a disadvantaged position. We do not want to expect more than what we are going to get. We want to only recognize revenue when we realize it. We want to recognize revenue when we realize it, but we are recognizing expenses whenever we think that we are going to incur them. So if you think that we are going to incur a certain expenditure or a certain loss, you must put it in the financial statements. But if you think that you are going to make a profit, you mustn't show it in the statement of financial position. So the profit must come as a surprise. That way, we would have observed this concept. So those are the concepts that I had prepared for you guys for tonight. There are many concepts. This is not the exhaustive. I have not exhausted the list. You can always go through the other concepts whenever you find the time. I just showed the most important or the ones that we use mostly when preparing the financial statements. So you want to look at the value and limitations of financial statements. So we have been talking about the values when we talked about the uses. So the financial statement serves as a source of financial information. So information is power. When people have financial information pertaining our business, or when we have the financial information pertaining our business, we can be able to make a lot of necessary decisions to alter or to continue what must be altered or continued. So the value, it comes in the value that it is a source of financial information. And then it has got a number of limitations. We are only going to look at three of them. So the first limitation is that of inflation. So you will see that at no point in our lectures or in our module are we going to talk about the impact of inflation on the financial statements, because the accounting profession as a whole does not take inflation into account when preparing the financial statements. So what impact that does this have? Obviously, a rand that we earn today is different from a rand that we earn next year. So we cannot put the same value to those two same amounts because of the what? Of the inflation effect. So we have a problem when it comes to the comparison of our financial statements. We might have made a profit this year, and then next year we realize a loss, but it is not really a loss, but the effects of what? Of inflation. So inflation has got a limitation when it comes to the preparation and presentation of financial information. Then the other limitation that we have is the accounting policies. So you will see that, of course, we have the GAAP, the generally accepted accounting principles. So those principles are expected to be followed by each and everyone who is performing accounting functions. But each and every organization have got specific policies that suits that certain organization. Those policies differ from one organization to the other, and those policies affect the financial statements significantly. We can be one organization can be making profits because of the policies that it has in place, and another organization can be making losses because of the very same aspect of the policies that it puts in place. So it makes it very difficult to compare the financial statements of two organizations, of two companies that may be in the same industry, because they are applying different policies, each of which applies the policies according to its management. So it is a limitation to the financial statements because we cannot be able to compare the financial statements of two companies. And then the last limitation that I have is that items that are not accounted for in financial statements. So when we were doing the principles, we left one, which is the principle of materiality. The principle of materiality, which says that only those items that have got an amount that is significant are to be recorded in the financial statement. So as we conduct our operations, there are certain transactions that we enter into, or there are certain skills that the organization acquires that we cannot put a value to. They are not accounted for in the financial statements. We talk of the managerial skills because obviously they have got an impact on the overall losses or overall profits of the company. They are not valued and therefore they are not presented in the financial statements. So one can be deterred from investing in our company because they do not know about our management. They can be a very good management and still one cannot invest because we cannot quantify that. So there's a limitation in the sense that there are certain things that we cannot put into monetary value and therefore we cannot record them. So that's it in as far as the limitations of the financial statements is concerned. Okay. So we want to look now at the characteristics of good financial statements. So for us to be said that we have done a good job in the preparation of financial statements, what must we have done? What really must we have done for our financial statements to be said to be in a good condition, or to convince the users of the financial statements? What should they include and what should they not include? So this is what we are going to be looking at, the characteristics of good financial statements. The first characteristic is that they must be understandable. They must be understandable. I have mentioned earlier that when we are performing the financial statements, we follow a specific format. We follow a specific format for standardization so that anyone from anywhere, when they look at our financial statements, they can be able to understand what we are doing, where we are coming from, and where we are going. So the formats help us to achieve this goal of understandability. So when one understands our financial statements, we can therefore say we have made good financial statements. The other thing that results in us saying that we have good financial statements is that we have to include relevant information. We have to include relevant information. By relevant information, I mean we must only include information that assists the users to make financial decisions. We must only include information that assists the users to make financial decisions. So as we enter into transactions or as we enter into binding agreements as a business, we enter so many of them, some of which affect the relevant users, but some of which do not affect the users of the financial statements. So we must be able to tell which one affects the users and which one does not affect the users, which one assists the users and which one does not assist the users. And only those that assist the users to make a financial decision is the one that we include in the financial statements. And then we also talk of the aspect of neutrality. The information that we include in the financial statements must be neutral. That is, it must not be biased in any way. For instance, we can tend to understate our profits so that we pay less income taxes. We can tend to understate our profits so that we pay less as taxes. That information becomes biased because we have deliberately given a false figure to achieve a certain goal. Or to lure investments, to lure investors, we can overstate our profits with the common goal of bringing more investors to the company. When they see that we are making higher profits, they would want to come and make investments in the company. That results in bad financial statements. So if the financial statements are to be said to be good, the information should be neutral. They should not be serving the interests of an individual or of the company alone. They should be serving the interests of those who the statements are meant to reach. And then for the statements to be said to be good, they must be complete. They must be complete. So we must have description in words as well as numbers. What do I mean? I mean, when we are recording our transactions, we just don't put numbers, or neither does we only put descriptions, but we put a combination of these two because we want to know what the certain figure is being associated with. Is it advertising expenses? Are they sales? How much are they? So we must include all the relevant information, all the information pertaining a transaction for it to be said to be complete. And then they must be comparable. They must be comparable. The aspect of comparability. So when we present, this is for presentation. When we present our financial statements to a certain specific group of users, we cannot present a financial statement for 1 year. We have to present at least 2 years, the previous year and the current year, so that the users can be able to compare whether last year we made a profit, this year it was an increase in the profits. So therefore, there is a possibility that the following year, the profits are going to be even more. So for them to be said to be good, there must be at least 2 periods that we are comparing. Okay, so that's it about the characteristics of good financial statements. Characteristics of good financial statements. So I know it can be tiring to listen to this theory, but it is very important. The theoretical aspect of accounting is equally important as the practical aspect. You cannot go to do workings without knowing this theory. So I urge you to be very, very attentive. Okay, so we move to the next aspect of our lecture today, which is the classification of financial information. The classification of financial information. So information in the financial statements can only be classified into 5 categories. So we have only 5 elements of financial statements. So these are what we'll be dealing with from the beginning to the end of this module. Only these 5. The first one are the assets. The second one are the liabilities. The third one is the equity. The fourth are the revenue. And the last but not least are the expenses. So we are going to look at the definitions of these. What are they? And why should we know them? So we've talked about assets earlier. We're just going to be reiterating just to make sure that the concept sinks. So assets are economic resources owned by a business. Economic resources owned by a business. What it therefore means by economic resources, it means we can trade assets for money. We can trade assets for money. So anything that we own in the business and we can be able to trade for money are the assets of the company. And we've talked from that slide, from that page I showed you, that assets have got a debit balance. And then we've talked about the nature of the assets in regards to their current and non-current characteristics. I think in the following or the one after this one, we are going to be looking at them. We see that this is the accounting question, but we just want to take a look at the examples of assets that we might have. We've got the land and buildings, we've got investments. So this is a non-tangible asset. I had forgot to mention about this one earlier. So we have current assets and non-current assets. On those non-current assets, we have tangible assets and intangible assets. When you talk of tangible assets, from the word tangible, are those assets that we can see and touch. We talk of the land and buildings, we talk of the motor vehicles, and any other things that we can see and touch and that we are expecting to use for more than a year. And then when we talk about intangible assets, we are saying as a business, we might decide to invest in other businesses. We might decide to invest in other businesses and earn a return from our investments. So those are assets that we hold, but we cannot see investments, we cannot touch them. So hence we term them intangible assets. So both intangible and tangible, both intangible and tangible assets are non-current assets. We expect to be having them for the foreseeable future, a period of more than 1 year. And then the non-current assets, the current assets, I mean, we talk of the debtors. So when we sell our goods and services, we might be selling on credit. Most of businesses runs on credit. So when we sell on credit, we make debtors. They are to pay in a specific period of time, be it 30 days, 60 days, 90 days, depending on company policies. So they are assets in the sense that it's money that is owed to us. We know that that money, one way or the other, is supposed to come. So it belongs to us. So in a way, it's an asset. Then we've got the cash. The cash is an asset because cash is already money that we have. So in its very nature, it's an asset. And then the cash at the bank or just the bank is an asset as well. So all these three debtors, cash and bank, they are what? They are current assets in the sense that we expect to have exhausted them in the current year. So we cannot have debtors that goes to the next period. Otherwise, we'll face cash flow problems. So the debtors always pay as soon as possible, which means they automatically qualify for the current assets as well as the cash and the bank. So we have many current assets that we can talk about, most of which we'll come across when we are doing questions. We will try to attempt as many questions as we can, because only then can we unveil some of the concepts that we might have overlooked in these lectures. So that's assets for you. Then we want to talk about liabilities. Liabilities are the financial obligations or the debt of the business. What the business is going to pay, what the business owes to other businesses. So this is the list of liabilities. I've mentioned that the nature of liabilities is the same to the nature of assets. We have current liabilities and we have non-current liabilities. Non-current liabilities are those long-term liabilities that we are not expected to settle within the current accounting period. So we can have liabilities running for 5 years, liabilities running for 3 years. Those are all non-current liabilities. For instance, we talk about a long-term loan. We get a loan to finance our operations, but we promise to pay after a certain period of time. And then that's a non-current liability. And then we've got creditors. As we can sell on credit, we can also buy on credit. When we buy on credit, we create what we call creditors, people whom we owe money. So we buy specific goods in order to resell them. We buy them on credit because we may not afford to buy them on cash. We might not have the cash at the moment, but we know that as we perform our business activities, we'll be able to generate cash and pay for those goods and services. So when we buy goods and services for credit, we create what we call creditors, and we have to settle their accounts within a specified period of time. Again, we cannot have creditors for a long period, because remember, they also need this money to sustain their operations. So they are current in the sense that we have to pay as soon as they want that amount, or at the agreed period. And then we have a bank overdraft. In some instances, our bank may allow us to use more money than we have in the account. There we create a bank overdraft. So a bank overdraft liability is the opposite of a bank asset. So when we use more money than we have in the bank, it's a bank overdraft. And it's a current liability in the sense that we're expected to pay that amount as soon as we deposit any money into the bank, or we are given a maximum number of time of period that we can stay with a bank overdraft. So we have to pay them back within the financial period, and therefore it falls under the current liabilities. So that's about liabilities. And then we want to look at the owner's equity. So the owner's equity is composed of 4 things really. I only mentioned 3, but there are four things. The first of which is the money invested, is the capital. Is the capital. Capital was defined in your previous lecture as the money invested in the business by the owner. So when the owner wants to start a business, he must have a certain amount to enable the operations of the business. You cannot start a business without any money. So that money which you invest, that money which you put to the business, is the capital of the business. So a capital has got a credit balance. Unfortunately, it's not mentioned on that first slide we talked about, but a capital should always be known that it has a credit balance. And then we talk again on the owner's equity. We find income. We find income. The amount of money received over a period of time from normal business operations. So the income that we find on owner's equity is the amount we receive from normal business operations. As we conduct business, we expect to generate revenue. We expect to generate income. We expect to generate money. That money is the income that I'm talking about as an owner's equity. So you will see that I have got a plus on the capital and a plus on the income. So the owner's equity, the reason why I have these pluses and a minus here, I will explain, is because the owner's equity is the money that belongs to the owner. The money that belongs to the owner. So the capital belongs to the owner. The income belongs to the owner. What does the capital do? It increases what belongs to the owner. What does income do? It increases what belongs to the owner. If the owner decides to stop operations, that's just a fictitious example, because remember we said we operate on a going concern basis. We presume that will be in existence for the foreseeable future. But if it's at any point the owner decides to stop operations and take all the money that is in the business, it is the total of the capital and the income and the following that we are going to talk about, and the expenses. So the expenses is an amount of money spent in order to buy or do something in the day-to-day running of the business. So as we conduct our business operations, we have to incur certain expenditure, certain expenses such as salaries to employee. We need to pay employees to be able to work. Expenses such as advertising, we need to advertise so that people know of our business. There are depreciation expenses. We'll be talking about this later. So expenses have got an impact of reducing the owner's equity. Expenses have got an impact of reducing the owner's equity. If the owner decides to close today, we'll take the net of the capital, the income, and the expenses. So we say the capital, we add the income, we deduct the expenses, and that's the take home for the owner. And the last part on the owner's equity that I want to talk about is the drawings. Drawings have got an impact of reducing the owner's equity as shown by this negative sign. So the drawings are the personal takings of the owner, what the owner takes from the business, but not necessarily for the purposes of conducting business. He can be taking stock for his personal use. He can take cash for his personal use. All of this would be regarded as drawings. And drawings have got an impact of reducing what he owns in the business. So that's about the definition of the components of the financial statements, which you say are 5. We have defined them all. We have talked about their nature and anything that we need to know about them. So that's pretty much it about the elements of the financial statements, and we need to know this from the back of our hands. And then we want to move to the accounting equation. The accounting equation forms the backbone of the profession. The accounting equation, like any other equation, should always be in balance. The accounting equation should always be in balance. So I am going to read to you what's here, and then I'm going to explain to you what this means and why the equation is said that it's always balancing. So the accounting equation shows when a company's balance sheet, on a company's balance, that a company's total assets are equal to the sum of the company's liabilities and shareholders' equity. So what you can deduce from this statement is that the accounting equation is practiced on the statement of financial position that we talked about in an earlier slide, because we said the components of statement of financial position are assets, liabilities, and equity. So we find these three in the statement of financial position. So it is the statement of financial position that guarantees the balancing of what? Of the accounting equation. So the statement of financial position should always be in balance. The statement of financial position should always be in balance because the accounting equation should balance at all times. So both liabilities and shareholders' equity represent how the assets of a company are financed. What do we mean by this? When we come to our equation here, these are liability and these are owner's equity. They both represent how the assets of the company are financed. So we acquire liabilities, be it a loan, be it a bank overdraft, or buying on credit for the purposes of financing the assets of the company. So here we should have inventory, those goods that we buy for resale to create creditors. So whenever we have creditors, it means on this side we must have inventory, because remember we are buying goods from creditors. When we buy goods, we must record them under assets because we are going to convert them into cash at any time. So the equation should therefore always be in balance because we are taking from creditors here and putting it on the assets. And then we can talk about the long-term loan. We acquire a loan to purchase perhaps non-current assets, the assets that we use to generate income, be it land and buildings. So we acquire a loan from the bank and we use it to buy what? Land and building. So if we take a loan from here and put it there, from general mathematics principles, we know that the equation should remain balances because we say -5 here and +5 there. So the equation must be in balance at all times because what is on the right side of the equation is what we use to buy what is on the left side of the equation. We acquire loan so that we buy buildings or investments or any other asset. So we take from this side, we put in this side, the equation should be in balance. When we sell assets, we can either repay, it would be for the purpose of either repaying a loan or making a profit. Either ways, the equation should what? Should stay in balance. And then the accounting equation is the foundation of double entry accounting system. The accounting equation is the foundation of the double entry accounting system. We have talked earlier about the dual nature of transaction when we were talking the principles. And we said that for every debit entry, there must be a credit entry. So the accounting equation is the reason why we must have what? The double entry system. Because again, when we take from here, we put here, we have another rule which says we debit the receiver and credit the giver. We debit the receiver and credit the receiver and credit the giver. So whenever we perform these functions, one party is losing and another party is gaining, both of which belong to the same equation. So the equation remains in balance at all times. It is very important that the equation is in balance at all times. And then you remember from the statement of financial position, we mentioned that it must what? It must always balance. So when the statement of financial position balances, we know that the equation is what? Is balanced, and therefore would have done justice in as far as the profession is concerned. And then we just I wasn't sure if you know this, but I just thought it's something that is very, very important for you to know. A transaction. What is a transaction? I've been talking about transactions. Financial transaction is the activity between two or more parties during which one party renders a service or sell goods for which the other party then pays. So if we enter into an agreement with another party, we decide to sell goods on credit to someone, that is a transaction. And in as far as we are concerned, a financial transaction, because we can put value to it. If we decide to employ human resource, it's a transaction that we enter because at the end of the period we are supposed to pay what? Salaries to that person. So it becomes a financial transaction. So any binding agreements that we make on behalf of the business are called transactions. And financial transactions in particular are those that we can put value to, because then if they become financial transactions, it means we have to record them in our statements of in our financial statements. So a transaction is an agreement between two parties, the business and the third party. So what should we remember about a transaction? We should remember that each transaction has two accounts. Remember, we talked about double entry. You debit one account, you credit another account. So each transaction must have two accounts. We'll look at this in detail when we are attempting a question. Then each transaction is a debit and a credit entry. For those two accounts, one should be debit, the other one should be a credit entry. So that our equation remains in what? In balance. And one account is debited, the other account is credited. Like I said, that the equation remains in what? Remains in balance. So we want to look at one statement, one financial statement for today, and then if circumstances permit, we will be doing questions on this particular statement. So this is the statement of comprehensive income. As sure I am, if not all of you, most of you have been through. So I want us just to explain what we expect to see in the statement of comprehensive income, the format of the statement of comprehensive income, the items, the contents of the statement of comprehensive income. We have talked about this We just want to see them now in figures and put in action. So I'm not going to bother you with this theory. We have already talked about this. We have already talked about this. So I want to go right into the what? Into the statement of comprehensive income. So you will see that we start with sales and we will end with net profit. What we want to look at in the statement of comprehensive income is the net profit for the year. So I cannot teach you how to know this format, but it is through practice that you will know. It is through practice that you know. So practice makes perfect. You are advised to be practicing this day in, day out, so that you know it from the top of your head if you do not know it already. So it starts with sales. We have explained that sales are those things that we sell in a business. Those products that we sell in a business, those are the sales, and they come as an what? As an income, because sales, we are giving them goods and they are giving us money for in return. So it is income to us. So sales is an income. So we write sales, we have a sales figure. And then we have a cost of sales. Like I said, that it has a debit balance. The sales have a credit balance. So if we put a credit and a debit together, it means we are subtracting. We are coming from a plus going to a minus, which means when we want to find the net of these two, cost of sales and sales. For us to make sales, we must have incurred certain costs, because those products that we are selling, at some point we must have bought them, or at some point we must have manufactured them. Those costs of buying or manufacturing are the cost of sales that we are talking about here. It's very fortunate that looking at the type of questions that you guys are asked, you are always given the cost of sales figure. In some instances, you're asked to calculate the cost of sales figure. We will tackle that situation when we come across a specific question that is talking about that. Otherwise, we might not want to waste our time on things that we might not be even tested on. So the net of sales and cost of sales, if we say sales, subtract cost of sales, whenever you see brackets, it means you are subtracting. If we say sales, subtract cost of sales, we have gross profit. So what is gross profit? Gross profit is the portion of profit that we can attribute to expenses. The portion of profit that we can attribute to expenses. So we cannot put all the sales towards expenses. We cannot put all the sales towards expenses, because remember, we have to pay the creditors. So we have to deduct their amount from the sales. So we cannot put them all towards the expenses. But after we have deducted the cost of sales, it means whatever we are remained with, we can then put it all towards the payment of what? Of expenses. But it's also important to note that of this gross profit, after we have deducted the amount that we want to put to expenses, we must be left with a profit for the what? For the owner of the business, because we do not want to be making losses. So we have to, at every point, try to minimize our costs in the business, so that we have something remaining of this what? Of this gross profit. So after gross profit, we put other operating income. Other operating income. When we talk of other operating income, I have mentioned earlier on that we have various types of income. When in as far as the business is concerned, we have various types of income, and I specifically mentioned the rental income. We might have buildings that is lying idle, and we do not want to waste it. So we decide that in the meantime, let us rent this building out, so that whoever rents this building will get to pay us for the period that they are using the what? The building. And that money they pay us is income, and it comes as rental income. You'll notice that we are putting it at this specific position in the statement of comprehensive income. It's because that's the format that we are required to be using. We could have put the rent income with the sales together since they are all income, but we cannot because the format tells us to put them into separate position. And then the other type of income that we might have is the discount received. So when we buy goods on credit, the person that we are buying from might want to encourage us to make prompt payments. Let's say the policy states that we should pay in 60 days. The person can they say, of these 5,000 that you are supposed to pay in 60 days, if you want to pay it today, we are going to reduce the amount with 2,000. If you want to pay this amount today, we are going to reduce the amount with 2,000. And then to say that the amount that we are supposed to pay is decreased. And that comes as an income to us because we were not expecting that money, but it came anyway. So it comes as an income. So you must record it under what? Under other operating income. So as we go through other questions, we'll find that there are many types of other operating income, and we are going to look at each and every one of them as we come across it. So here we add, if you see there, these two are in brackets, so it means these figures are adding each other. 60,000 of rent income and 2,000 of discount received, we get 62,000. So that's the total we get from the what? Other operating income. Therefore, we add our gross profit with the other operating income, because remember, this is the amount that we have. These two figures are the amounts that we have. If we did not have any expenses in the company, this was going to be our take home amount. This was all going to be the owner's amount, money. But because we have expenses that we are going to look at, we are going to be deducting this amount from those expenses. So add 562 to 62,000, we get 624,000 gross operating income. Gross operating income. So this is the money that we have available in total to spend on expenses and to reserve for the owner as a return for their investment. So we move to the operating expenses section. We will find wages. Wages are the amounts that we pay to what? To our employees. Wages and salary are the same, and salaries are the same things, but just that it is the period that differs. When we say wages, we usually mean they are paid within a period of less than a month. So a company may be paying every fortnight, it's a wage. A company may be paying its employees every week, that is a wage. When the company is paying monthly, they become salaries. So their expenses, we record them under expenses. And then we have bank charges. Bank charges are whatever the bank charges us for the services that they provide. So we keep our money at the bank, we must be charged. We perform transactions using the bank, we must be charged. So those are operating expenses. For us to be able to operate, for us to be able to make payments, to receive payments, we must make use of the bank services. So we cannot continue operations if we do not have what? The bank services. So as they are vital to our operations, we have to note the expenditure that we incur because of them. Then there is packing materials. In some instances, you might find the right packaging materials. So you might be acquiring goods and then you put them in packages that has got your brand on. So you might be acquiring goods in large quantities and then you repack them at your factory to put them in packages that are easy to sell and that are easy to handle. So we need material to package. That material, we record it as a what? As an expense, because we have to incur it to enable the operations of the business. Then we talk of advertising expenses. Self-explanatory, this one. We need to make our products known to the general public. So as we incur those costs, we have to show them in the statement of comprehensive income. And then we've got rates. Rates, when you talk of rates, we are talking about be it electricity, be it the water that we use on our premises, those are rates. So we must also include them, because we cannot have a business. We cannot run a business without rates. People will need to drink water. We will need electricity for our transactions. So we have to show them under operating expenses. And then we go to bad debts. So when we sell goods on credit, some of the people that we sell to pay back our money, but we cannot overlook the possibility that some of the people are not going to pay. When it so happens that we have people that fails to pay their debts to the company, it becomes an expense to the company, because we have acquired them at a value, but we cannot recoup that value. We cannot recover that value. So automatically, we are the ones going to incur the what? The expense. So we showed that under the expenses section of the statement of comprehensive income, to say that we incur the bad debts of what? In this instance, they were of 2,800. So we are always told by the question, it's not that we always have bad debts, but the question tells us whether we have bad debts or we do not have bad debts. When we have bad debts, we record it under what? Under expenses. And then we have got the discount allowed. Just as we have got the discount received here, on the discount received, we said when we buy on credit, to encourage prompt payment, they can offer us a discount to say if we pay now, we have to pay less. We can also do the same to our customers, because remember, we need cash. Cash is the lifeblood of a business. So the sooner we convert our products into cash, the better for us. So to be able to convert them into cash in the lowest possible period of time, we can offer what we call a discount. And if a discount is coming from us, it's a discount allowed, because we are allowing for the discount. So a debtor might owe us 2,000 or 6,000 rather. And then we tell them that for that 6,000, if you are going to pay now, we are going to deduct 1,000. So you actually pay us 5,000, and the other 1,000 will be the loss. So in a way, it's a loss to us, because we have not received the full amount that we're expecting to receive. We have done so to receive the cash in the most shortest period of time. So that's the discount that's the discount allowed, and it comes as an expense always. And then we have stationery. Stationery are the items that we buy and we expect to consume within the following year. We expect to consume, within the current year. So when we talk of stationery, we talk of items such as writing pens, bond paper, anything that we use, invoice books, etc., etc. So we buy those in anticipation that we are going to use them in the current period. We cannot buy invoice books for the following 5 years, because remember, we need that cash for something. So we would rather buy what we only need in this year. So stationery is an expense, because once we use a receipt book, we can no longer use it again. It becomes redundant, and therefore we would have incurred an expense in the sense that we are not recovering that amount. And then we find water and electricity. I have explained this under rates. So Okay. We see here that Jasper Jumo raised a hand. Jasper Jumo. Hello.
Yeah, no, you can continue.
Okay. Thank you. We've explained water and electricity under rates. These are the rates that we are talking about here. I don't know why we have them in separate categories here, but under normal circumstances, this is what constitutes two rates. This what constitutes two rates. And then we have insurance. We have insurance. So as we are in operation, we have to insure our assets, be it our production plant or our motor vehicle or our buildings. We have to insure them against against certain hazards, be it theft, be it fire, be it what. So these are necessary expenses. These are necessary costs to incur because we know that in the event that the car is stolen, we can claim for insurance. So in the meantime, it is an expense because we cannot be able to claim now until it is stolen. So we record it under expenses. And then we also have telephone expenses. In the ordinary course of business, we have to make calls. We have to communicate with the external or even the internal stakeholders. So we would need the telephone costs. So all of these costs, they come under expenses. And then we have depreciation. We have depreciation. Depreciation goes hand in hand with the assets. So as we use our assets, we must agree that they depreciate or they lose value. We cannot use a car for 10 years, a motor vehicle for 10 years, and expect it to have the same value that it had the first year that we acquired it. So as we use an asset, it faces what? Depreciation. The assets that usually faces depreciation are the motor vehicles. The land and buildings, usually they do not depreciate because it's a matter of repainting and doing whatever. But the question with motor vehicles, you cannot repaint in it and expect it to be new. You would have to either buy a new one or just redundant the current one. So the depreciation is the amount, is the cost that we incur due to using an asset, due to using a motor vehicle. Like I said, that depreciation is only charged to more motor vehicles or moving automobiles. So that cost that we incur as we use a motor vehicle is depreciation. So we have got different methods of calculating depreciation, some of which will be, in fact, all of which we'll be looking when we attempt a question, all of which we'll be looking at when we attempt a question. But for the purposes of this lecture, maybe I should just state that we have got the straight line method of depreciation, and we've got the reducing balance method of depreciation. Maybe some of you have heard about this, some of you have not, are still yet to, but those are the two kinds of depreciation that we have. And it comes as a policy to then decide which one do we want to use. It differs from one organization to the other, whether you want to use the straight line or the reducing balance, both of which have got specific advantages and disadvantages to the company, ones which we will look at as we proceed with the module. And then we have other operating expenses. So as we operate a business, there can be certain expenses that we cannot provide for their accounts as individuals. They can be so insignificant that to say that they have an account of their own would be a futile exercise. So we just bracket them under other operating expenses. So other operating expenses are any other that are not included here, any other that we have not talked about, any other expense that the business has incurred. We need to include it because remember, we have to record each and every financial transaction, each and every expense, therefore, must be recorded. But if it so happens that we cannot record it as a separate item, we put it under a bracket of other operating expense. So if we sum up these expenses, you'll see that we have a bold border here. It means these expenses are going along. So if we sum up these expenses, you'll find the operating expenses. So the total always comes on top of the what? On the of the box. If you come here, the total here came on top of the box. So we add these totals, we find this one. So we go on to say now, we said gross income is the income that we are committing to the expenses of the company and the take home for the owner. So we are committing this income to the expenses. So from this income, we deduct the what? The expenses. After deducting the expenses, we will see that we have what? Operating profit. Whatever is left after deducting the expense is the operating profit. Whatever is left after deducting the expense is the operating profit. One can say is the take home for the what? For the owner, but we are yet to go. We are yet to go. We still have to put these two items here. So these are interest income and interest expense. So what is interest income? Take note that this only comes after the operating profit, as the format suggests. As the format suggests. So whatever the format suggests is what we do. What is interest income? We might choose as a business to lend someone some money or to make investments, as I alluded to earlier on that slide of intangible assets. We can make an investment. That investment generates interest for the company. That investment generates interest for the organization. So that interest income must be realized. We can only realize it after what? The operating profit. So the interest income, if we had any, it was supposed to come here and it was not going to be bracketed like this one, because remember, it's coming into the company. The sales is income coming into the company, they were not bracketed. Other operating income, we did not put a bracket to it. So interest income, we do not put a bracket. So on every income item, we do not put a bracket. We only put brackets on expenses or money that is going out of the business. In this case, we put a bracket here, symbolizing that we are reducing. So that's it about the interest income. And then we talk about the interest expense. Interest expense, when we acquire a loan, we are bound to pay interest on that certain loan. Because remember, those who have afforded us the loan, they require a return, not only of the original amount, but with an interest on top, because otherwise they would not have any motive to lend us the money. So the interest is their motive to lend us the money. So the interest expense to us, so the interest that we pay on a loan or on a mortgage or on any type of liability to us comes as an expense, because we are saying on top of that capital amount that we borrowed, on top of the amount that we borrowed, we are going to have to pay an interest to it. So we are paying more than what we received. And hence to say, it is an expense to the company. So an expense is money that is going out and it's always put in brackets. So when we put in brackets, we come from our operating profit. We put, if we had interest income, we have put not in bracket. And then now we have an operating interest expense, we put in bracket. So it's 310 plus 0 minus 12,000. We'll find that we have what? 298,150. So that is the net profit that we made for the year. In other instances, we can make a loss, but in this particular, we made a profit, which is good for the business. Like I said, we are in business to make profit. And when things goes this way, then we clap hands for the management, because they have been able to provide a return for the investor, for the owner. So the owner can do various things with this money. He can decide to take it out because it's his money. He can decide to reinvest it into the business. So most of the times you find that the employer, the owner of the business decides to reinvest this amount into the business because he wants to make even more profits. If he decides to take some amount, then it's fine. He is not disallowed. But if he wants to reinvest, he is also allowed. So that's it about the what? About the statement of comprehensive income, and that is what we hope to have mastered by the end of the module. So if circumstances do permit, we are going to attempt questions pertaining the statement of comprehensive income. As you might have seen, or as you might agree, it doesn't come as simple as this. Usually we have adjustments to certain information that we would have to make before recording these transactions. We are not just given these transactions out of a shelf. We have to come up with these with these figures so that we come up with the appropriate profit or loss for the year. That is what we want to seek to understand by the following and preceding lectures. How then do we tackle each and every question pertaining the statement of comprehensive income, given in whatever way that it comes? It comes in different ways. We must be able to familiarize ourselves with most, if not all, of those ways, so that at the end of the day, we know this particular statement of comprehensive income, we know this particular financial statement, and we are comfortable, we can be able to tackle any question at any given time. So again, if circumstances do permit, in the next lecture, we are going to have a question pertaining to the statement of comprehensive income. And if time permits, we are going to introduce the statement of financial position. So as time goes on, we are going to be tackling questions. Each lecture we have to make sure that we have a question that we tackle. But I would like to stress on something. We can only benefit from these lectures if you guys maybe prepare in advance, so that when we conduct the lecture, you have things that problems or challenges that you faced when you were going through the content that you might want to ask, or when I'm explaining the things here, you would then grasp the full concept of what was meant. So it can only be achieved if you guys prepare in advance. So if circumstances permit, I'm going to circulate a question to the admin, and then you make sure that you get it in the next lecture. We attempt that question. If you guys have also questions pertaining statement of comprehensive income that you have encountered and you want a clarification on, you are free to give them to the admin, so that he gives them to me. So that's all. That would be all from me for today. I will hand you to Mr. Noel. If you have any questions, contributions, or subtractions pertaining to this lecture, you are allowed to do so right after Mr. Noel. Thank you, everyone. Over to you, Mr. Noel.
Okay. Thank you, Mr. Rubin, for the lesson, and thank you guys for coming, for participating. I think I will send full information to the group about how are we going to conduct our lessons, how are we going to share with you the notes, the videos, and everything. So thank you guys for coming. Thank you, Aki. Wow, what's my king? Hello?
Do we have anyone with questions from the audience?
Okay.
No, thank you. I'm good.
Okay, thank you. No one else?
I think
Okay.
they are saturated with information.
Yeah, I do believe that the theoretical aspect of accounting can be a bit tiring, but thank God that this is all of the theory. Thank you again.
Okay, bye bye, guys. Thank you.
Thank you. Goodbye.
Bye.
you.
Thank you.
Yeah.